Should I borrow from my 401k? Borrowing from your 401k plan can be a life-saving decision when you have to pay off a large and unexpected debt. However, tapping into your 401k is not something you should take lightly. While a 401k loan would be tax-free, you could easily get into more financial problems if you do not set up a proper repayment plan. Before you take that step to borrow from your 401k plan, here are some factors to take into consideration as well as the pros and cons of taking a 401k loan. Who should borrow from 401k? Borrowing from your 401k plan should only be done in times of true emergency where the reason for it is a need and not a want. When you take from your retirement account, it has the potential of derailing your retirement investment progress. You should only take from your retirement account if you need quick cash to handle an unforeseen medical situation or repair your home after a natural disaster. Also, you should only consider tapping into your retirement account if you need to make a down payment for a home. If you're planning on moving on to another job in the near future, it would be unwise to tap into your 401k even if it is for a true emergency. Pros of borrowing from your 401k. No need for credit scores and credit reports. When it comes to accessing loans, your credit score and credit report not only determines how much you would be eligible to borrow but also how high your interest rates would be. Since you're accessing your own saved money, you won't have to worry about that and your employer won't ask for a credit score to assess your creditworthiness. Lower interest rate. This is one of the best pros when it comes to borrowing from your retirement account. Unlike borrowing from banks, you're more likely to get a lower interest rate with a 401k loan. The difference is usually very steep taking the data into account. Most banks would charge the least risky corporate clients around 3.25% interest, which you would most likely not fall under. With 401k loans, the interest rate is usually 1% or 2% v. No tax deductible. Borrowing from the bank or other borrowers would attract taxes on the amount borrowed, but that's not the case with 401k loans. However, borrowing from your retirement would require some sort of discipline in terms of paying it back. You won't be charged any income tax or a 10% early withdrawal penalty on the money you take out as long as you pay it back in time. This could be about 5 years but can be as long as 15 years if you took the money to finance a home. Cons of borrowing from your 401k. You might not be allowed to borrow. Not every employer allows workers to access the money in their retirement account, so you might not be able to get a 401k loan in the first place. To confirm the status of your 401k loan as to whether it is possible or not, you should contact your plan administrator. Borrowing limits. Other types of loans have a borrowing limit that is decided by your credit report, credit score, and your ability to pay back. This means you could get a lot more money if you have a great credit score and credit report. However, with 401k loans, the limit is pretty much set regardless of how less of a risk you are. You can only borrow a max of $50,000 or 50% of the balance, whichever is less. Even if you plan to take out multiple loans, the total must fall within that amount. Employer attachment. As stated earlier, you would have to reconsider taking a 401k loan if you're planning on changing jobs in the near future. If you leave your employer before you repay the loan, the terms would no longer be in your favor. The outstanding balance could be treated as a taxable distribution unless paid completely within a specified amount of time. To avoid that, you would have to stick to the job longer than you would want to. Losing bankruptcy protection. This is the most problematic issue with taking out a 401k loan. During bankruptcy proceedings, assets of your 401k would be under protection from creditors. However, if you take out funds from the plan to pay debts and you fall into more financial woes that cause you to file for bankruptcy, the remaining funds could be seized by creditors. Alternatives to borrowing from your 401k. If it is possible, you should leave your 401k plan untouched, especially if you're not sure about your ability to repay the loan within the specified time, or you would end up falling into more financial problems. Before considering dipping into your 401k plan, you should make sure you have exhausted these alternatives. Savings. When in need of emergency cash, the first place to look to is your savings. This is why you should have emergency savings. You could assess a good amount of the money needed for the emergency, which should give you enough time to come up with the rest. Take out a personal loan. Most people would prefer a 401k loan to a personal loan due to the fact that it is tax-free and you won't have to submit a credit report or worry about getting a high interest rate. However, you should first consider taking a personal loan before settling for a 401k loan. This is because personal loan terms are usually easier to repay and you won't have to jeopardize your retirement funds. Also, personal loan funds can be approved within a day or less, while 401k loans could take a while. HELOC. If you own a home and have the right equity to borrow against, you could try a home equity line of credit or HELOC. You can take as much as you're approved for. Take out a home equity loan. If you're avoiding taking a loan due to high interest rates, a home equity loan can get you a lower interest rate. However, your home would be used as collateral. This is an installment loan, and defaulting on payment would see you losing your home. Bottom line: if you've exhausted all alternatives, then taking money from your retirement account might be the best option for you. Before doing so, you should read up on 401k loans and the repayment guide to help you know if you can keep up and pay everything within the stipulated time to prevent income tax and withdrawal penalties.